Thanks for joining us today. This session is all about financial leadership, not just bookkeeping or spreadsheets, but how board members make the kinds of decisions that protect property values, prevent crisis, and build trust in your community. If you are a board member, you are a financial steward. You control a budget, approve contracts, monitor collections, and plan long-term investments that impact every single homeowner. Today, we're going to talk about what's in your financial packets and how to read them, the KPIs you should monitor, enforcing collections fairly, how and when to use loans, budgeting and reserves, and how to communicate all of this to your homeowners. Let's begin with the foundation, understanding your financial reports. Every month, your management company should deliver a comprehensive financial report package. But not all reports are all created equal, and not all boards read them. At RowCal, we use modified cash accounting, which means income is recorded when it's billed and expenses when paid. This gives you a real-time view of the association's financial health. Here's what to expect in your reports package. The balance sheet. This shows what the association owns and owes. Income statement compares budget to actual revenue and expenses. The age delinquency report tracks owner balances by how overdue they are. Bank reconciliation verifies your records. Match the bank account. Check register, it details every payment that was made. And accounts payable list upcoming vendor obligations. Prepaid assessments shows dues already collected for future months. One of our HOAs had a budget surplus every month, but their cash was mysteriously shrinking. A deeper look reviewed they were making payments for capital repairs directly from the operating account instead of their reserve fund. A simple review of the balance sheet would have prevented that mistake. Monthly reviews matter. That's how you catch errors, monitor trends, and prevent financial blind spots. Financial reports are just data until you know what to look for. Here are the critical indicators every board should track. Assessment collection rate, target 98% or higher. Delinquency over 90 days, keep below 5% of the budget. Monthly budget variance, flag any line item that's plus or minus 10% or more. Reserve contribution compliance, are you transferring monthly as budgeted? And then cash versus insurance deductible. Can you pay your deductible if there was a claim? Accounts payable aging. Are bills being paid within the terms? A board once asked why their landscaper stopped mowing. Turns out the last 3 invoices hadn't been paid. The check registered had shown it, but no one looked. Monitoring KPIs is like checking the gauges in your car. Ignore them and you risk a breakdown. A strong budget is more than math. It's your roadmap to stability. Smart budgeting means starting early, July through September, for a January fiscal year. Working closely with your manager and treasurer, reviewing 2 to 3 years of historicals, forecasting next year's vendor increases, and critically including reserve transfers in every draft. Here's some best practices. Zero-based budgeting. Don't just roll over last year's numbers. Build it from scratch. Use round numbers. Owners don't appreciate decimal dues. Simplicity builds trust. Communicate the why. Tell your community how increases protect their investment. One association froze dues for 7 years. They said, we want to keep things affordable. But their pool pumps failed, then irrigation, then the roads, and the special assessment, $6,000 per home. Affordability went right out the window. Budgeting is about long-term protection, not short-term popularity. Let's shift to something no board enjoys, but every board has to manage: delinquencies. Collections aren't about being harsh. They're about fairness. If someone doesn't pay, the rest of the community absorbs that cost. The RowCal collection process starts with a friendly reminder, simply sent after the due date. Then comes a late notice that includes the late fees and explains any consequences. If the balance still is delinquent, then we move to a demand letter, legal notification of the debt. Then we have to file a lien. This secures the HOA's position on that debt. And lastly, referral to a collections agency or an attorney. This pursues the payment, and here's the golden rule. Apply your policy to everyone, no exceptions. There was an HOA that was sued because they waived late fees for 2 longtime residents, but not others. The court found it was selective enforcement. And the HOA, they had to pay the legal fees. What they thought was kindness became a liability. Collections are not personal. They're a process. Stick to the plan. Let's talk about borrowing. HOAs can and often should consider loans when major projects arise. The need for them? Well, if you have multiple repairs but are underfunded reserves, want to avoid sudden special assessments, or you need to act quickly after a storm, then a loan might be the right tool. The first part, check your governing documents. Do they even allow loans? Can the board approve, or do you need a membership vote? What is the loan threshold or term limit that triggers a vote? The next step, work with your manager and an HOA banking specialist. Their loan process starts with just a simple review of your financials, reserve study, and the scope of the project. Then it moves to pre-approval screening. The lenders look at delinquencies, owner occupancy, insurance status, and legal matters. Then formal underwriting takes place. The loan amount, the term, the rate, the repayment plan that's offered. Then legal review by your association attorney, and then we move to the vote. That may be just a board vote, or it could require a membership vote. Then once all that is said and done, they disperse the funds into your association bank account. The repayment process, the monthly loan payments are added to the budget. They're often backed by a special assessment or a dues increase. They can be limited for, say, 10 years or 15 years. But here's a story. One association had a $1.2 million siding project and only $150,000 in reserves. The board panicked, but they worked with RowCal and a lender, and they secured a 10-year loan. They communicated the plan clearly, and not a single owner opposed it because the decision made sense. Loans aren't failure. They're financial tools. Use them wisely. You should never ask, do we have to fund our reserves? The answer is always yes. Reserves protect against future expenses. They prevent emergency assessments. They influence buyer and lender confidence. If your last reserve study is older than 5 years or hasn't been followed, it's time to update it. Your budget should include monthly reserve contributions based on the study, not whatever's left over. There were 2 HOAs. Both had a $200,000 roofing project. One of them had $180,000 in reserves and just had to borrow $20,000. The project finished with no drama. Unfortunately, the other association only had $15,000, and the other owners were hit with a very large special assessment. And unfortunately, 2 of the unit owners went into foreclosure because they weren't able to afford the assessment. Reserves are not savings. They're security, and they protect your fellow homeowners from financial uncertainty. Transparency builds credibility, especially around money. Boards, you need to send a summary of the budget annually and your financials monthly. Explain any increases in very plain language. Offer a town hall or video Q&A for budget rollouts. Share how your decisions protect the owner's property values. So instead of saying, we're raising dues 8%, try, we're increasing dues by $12 a month to fund reserves, cover insurance increases, and avoid special assessment. This protects your property and avoids surprises. When owners understand the why, they're likely to support the what. Let's wrap this up. Financial management is leadership, and the decisions that you make today will shape your community's future. What do great boards do? They know their reports. They track the right metrics. They enforce collections fairly. They use loans strategically. They budget with foresight. They fund their reserves consistently, and they communicate clearly with their homeowners. You are not alone. At RowCal, we're here to guide you through all of it. Now, thank you for your time, and thank you for your leadership. Let's build financially strong, forward-thinking communities together.